Bringing in another prominent voice, Sanjay Dutt, Director at Quantum Securities. He's joining us on the show right now. Sanjay, good morning to you. And are we getting a little bit excited? We have still got a lot of headwinds in terms of events that can really cause heavy volatility. But for now, we seem to be okay.
Yeah, I think so. You know, barring 100, 200 points in the Nifty here and there, the focus would continue to remain on the, second tier and third tier of the market. That's the mid and the small caps, because quite a few of them have corrected substantially. I'm not saying that they're dirt cheap or they've come to valuations which are extremely compelling and they're no-brainers. I think the earning uptick is still a big question mark, because what we've seen in the December quarter doesn't give enough confidence to give much higher multiples to these companies. But comparatively, their valuations are reasonable at this point of time. And in fact, in some of them, you might find them, cheap also compared to the, last 10, 15 years benchmarks they've had. So that's the reason why I think some kind of an oversold, some kind of an under ownership in the mid-cap small tier is what is correcting, particularly from the fund side. And of course, retail and private client group is coming back into the market a little bit. It's to be seen whether it's sustained or not. I always believe that earnings and flows are going to matter. If we have reasonably good flows carrying on into the emerging markets, India will do well. And within the basket, good quality mid caps would do better than the large caps at this point of time.
So what should the investment mantra right now be, Sanjay? I mean, a lot of chatter around whether or not the trade wars will get concluded soon enough or no. That could be a positive. What's been happening in the global market setup, our own elections outcome, that is the most crucial event that everyone's watching out for. If you get a stable enough government, then obviously the earnings potential will match the market returns. But what would the mantra according to you be right now?
According to me, I don't think politics are really going to play that much of a role, barring, of course, we get some major negative surprises in the form of a complete mess of a coalition, and one is, the country goes into uncertainty for a few weeks before a stable government comes into power. I think barring that kind of a outcome, I don't see much of an impact of the elections coming on the markets, because the focus, like I said, would remain on earnings, whether the earning cycle starts to improve, the private capex starts to improve, flows continue to remain or flows start increasing, both whether it's domestic mutual fund flows from retail investors, as well as, more importantly, flows from international investors. Because till the flows don't come in and earnings don't start looking better, they're obviously linked also to quite some extent. I don't think there's any other event that's going to have much of an impact on equity prices here. Trade war, those kind of issues will, sort themselves out. They've kind of more or less played out in the prices. Like I said, even politics has played out quite a bit, according to me, in the prices. Barring, of course, a big major negative that that shows up end of May or something like that. Otherwise, the focus should be just granular, look at independent companies, and just keep nibbling.
Interesting. Sanjay, good morning. Almost seems like the concerns that were in the minds of the market dissipated the last few days. My question to you, therefore, would be that if you were somebody who was sitting on anywhere between 10% to 15 to 20 to 25% of cash, would you, over the next 2.5 months, barring anything unforeseen coming out, be comfortable deploying that entire spectrum and be fully invested?
Yeah, I think if I have a longer term horizon and I'm not going to get worried about what's going to happen in the next 2, 3, 6 months, I have no doubts about the fact that there isn't a better time in the last many years to invest now, because a lot of structural changes that have happened in the economy, in the system, are actually going to pay dividends in the next few years. Whether it's been, the GST, we've seen the initial hiccups. We're definitely going to see better collection, because the government is going to get very aggressive post-election on enforcement and compliance. So, the collection shortfall that we've all been looking at, that 1,10,000, 1,20,000 crores not being reached, I think that would be bridged. And obviously, once the economy starts to pick up and the earning upcycle comes in, which I'm reasonably confident would start having an impact. Whatever we say, these kind of measures of, giving out 75,000 crores to poor and marginal farmers and those kind of things, they're definitely going to have an impact on the economy. The government spending on infrastructure and those kind of things, that's aggressively happening. And irrespective of the government, that will continue to happen after the elections also. So my sense is that this is definitely a good time to deploy that 20-25% cash that you've got, lying with you. But do it wisely, look at granular, look at companies individually. Don't get swayed by index levels, whether it's 11,200 you're deploying it or whether you're deploying it at 10,800. Focus purely on good quality companies.
Interesting. Sanjay, may I ask you if in your quest for doing this bottom-up investing, are you looking at newer avenues which you would not have looked until now? Or are you looking at companies which were trading at premium valuations and have corrected temporarily in your mind due to certain mismatches that may have happened in the industry, autos, cement, real estate, for example?
I think a mix of both. Autos is one sector which I'm a little wary of right now because all sectors, all products, everything goes through a little bit of a life cycle. I think autos can't continue the scorching pace that they had quarter on quarter for the many quarters. It'll take a little time for them to come back to the same growth, so that the time may be a few more quarters. Autos I would maybe a little concerned about, and for me autos is more of an issue because I see a structural change happening in the entire industry because with the EVs, the environmental issues, the product life cycle issues and various categories of vehicles. So therefore I would like that to play out because there are a lot of uncertainties there. But in the other sectors, I think where good quality stocks have corrected, which I already have exposure, and have corrected 25 to 40% for no real reason as such, are not leveraged companies, not over leveraged companies, I would invest. New areas also definitely. I think market has thrown up very good opportunities, and I think one place where I've been positive on for the last few months is PSU banks, which have started looking up in the last few weeks. And I think there's a lot of room for them to go up if you compare them with the peers in the private sector. We can't have a banking industry being totally disconnected where private sector players are running at 4, 5 or 6 times book, and public sector banks, having now cleaned up a lot, are not going to have credit growth, are not going to be part of the business. So I think that's one sector there's going to be a huge opportunity, even though stocks have gone up 15-20% in the last month or so.
Sanjay, just a few months ago, when the volatility in the market with regards to crude oil prices moving up, the currency depreciation, the more favored pockets were pharma, were IT. Are these pockets still of interest right now?
Very selective, but if I would say sector overweight, I don't think so, because they've primarily been defensives. But I think if you're going to bet on the fact that, which my hypothesis is that, economy, earnings and everything is going to look better ahead in the next year or two, then I would prefer, being in more aggressive growth, more aggressive kind of bets, higher beta bets, which have beaten down a lot, than kind of being overweight or than giving that kind of being exposed to farm or IT. Of course, they have to be part of your portfolio, but at this point of time, you probably could take better bets elsewhere, a little more part of a portfolio compared to IT and pharma.